We do bonds at Pimco, and like any house, they want to strategically look forward out 10 years. They said choose equities, and they chose Neel Kashkari out of the Bush administration to do equities. What's the biggest challenge of starting an equity house?
You know, the best thing we have going for us is there's tremendous talent available who are interested in joining Pimco. So the good thing is there's great talent. The hard part is stocks and bonds are differently. Bond folks tend to be pessimists, looking out for what can go wrong.
No way. Really?
Equity
That's
investors,
a great exclusive. Gross, a pessimist.
Equity investors tend to be more optimistic, looking for where's the bright side, what can go right. So we're always focused on four things. What do we think should happen? What do we think is likely to happen? What's the worst case scenario and what's the best case scenario, and putting those two things together.
What can you learn from other equity shops just up the road? Capital Guardian Trust, the Wellington model, John Kerry at the Pioneer Fund taking over for Phil Correa and others. What is the equity methodology that gives you what you need in marketing, which is those 4- and 5-star Morningstar funds?
Well, we're actually doing things a little differently than what other people have done. We have the advantage, we're starting with a clean sheet of paper. So we're starting with a rigorous individual bottom-up company analysis. We're analyzing companies in the context of Pimco's global economic views, and then we have a keen eye towards downside risk management. So all of our equity strategies have those three components: bottom-up, top-down, and risk management. We think those three things are key to investing in equities successfully.
How are you going to use that piñata known as the sell side? How do you use the sell side here to leverage further the knowledge of your internal analysts?
Well, our view is the sell side is an important information source. So we use them to gather some information to augment the own research that we're doing. Our equity professionals go all around the world meeting with companies, getting firsthand insights into local conditions at those companies and in those economies, and those insights are woven into the broader Pimco process.
Right.
So not only are our equity investors becoming better for being at Pimco, the rest of Pimco is benefiting from their expertise as well.
This is very good lines here, Neel. This is one massive shameless plug. Bring up the challenge here, which is nominal GDP. This is part of the new normal here at Pimco, and you can see how we roll over here in the U.S. market. There's the crisis. We come down, and top line GDP rolls over. What's the actuarial assumption of equities at Pimco?
The actuarial assumption of equities.
What's the return going to be? Is it a 5% world? Is it a 10%
It's somewhere
world?
between the two of those. Remember, Bill mentioned it earlier. For 30 years, our economy has been piling on debt. Debt accumulation was the rising tide that lifted all boats, drove asset prices higher, drove GDP growth higher, and you didn't have to care about income because prices just kept going up and up. Now in the new normal, the private sector is paying down debt, asset price returns are going to be more muted, and so things like dividends are becoming much more important for investors.
What can you learn from, say, someone like Tony Crescenzi, who joined us on Bloomberg Surveillance? See that interview at Bloomberg Radio Plus. Bring up the Crescenzi quote, if you would, Rex in New York, and you can see here, Beyond the Keynesian Endpoint is Tony's new book, and talk about the holy grail to look beyond Keynesianism and find new means of stimulating growth. Others will cling to the old way. What kind of company stimulates new economic growth?
Well, innovative companies. So companies that are creating new products, deploying new technologies, selling products that people all around the world want to buy. Think about the U.S. For the last 30 years, consumption and housing have been our pillars of economic growth. Consumption, U.S. consumers still have many more years to pay down their debt. Housing, you heard from Scott Simon this morning, has many more years ahead of it before it can start contributing. So we need to produce goods and services that people around the world want to consume. Real economic growth.
Right. Let's bring up a chart here. They've done better than good with the management change here. IBM, full disclosure, I'm a modest shareholder. Buffett loads the boat on IBM, loads the IBM boat. Of course, that was on CNBC this morning, and you see the surge. How do you avoid needing to place capital, particularly with the way the mailroom here fills up with checks? How do you avoid buying Apple or IBM at the top?
Well, we're going all around the world, so we're not constrained to benchmarks. We don't have to own the U.S. just because the U.S. has a large...
You're not going to manage for an R-squared of 92.
We are very unconstrained. So, for example, our deep value strategy completely ignores what's in the benchmark when deciding what stocks to buy. Our emerging market equity strategies doesn't only buy companies headquartered in the emerging markets, also buys Western companies that are selling into the emerging markets. So the key to us is forget about benchmarks, focus on finding the best ideas possible all around the world.
Can you sell that to pension consultants and retail consultants that are benchmark based?
It's an ongoing conversation. Not all clients are ready to be so forward-leaning. We would rather be skating ahead of the industry, skating to where we think clients and investors should be going, than be tied to the legacies of the past, which in our view has not served clients well, especially going into the crisis.
When you, and we're going to come back, but when there's so much to talk about here, you look at the debacle of the last 10 years. Do your economists presume a continuation of that? Or can we get a leg up, as a number of people are suggesting?
I think that there are positive surprises that could happen. If the U.S. political system can come together, actually tackle our debt and deficit situation, if we can pass pro-growth structural reforms, I think the next 10 years could look a lot better economically than the last 10 years. But it's up to us. We have to hold our politicians accountable and make them make hard choices if we're going to have the next 10 years be better than the last 10 years.
Oh, and we are thrilled to have joining us, spur of the moment here at their world headquarters, the laureate from New York University, and of course for years at Stanford University. My book of the autumn year. Michael, you can look over here. Michael Spence joins us from NYU. Michael Spence's book, The Next Convergence, is one of my most important books. It's about economic growth. How do you take the academics of Spence and pull it over to security analysis?
Oh, we think it's critical. I think Mike is a great resource for us. The insight that he brings. Again, all of our strategies in equity investing are global in nature. So individual company analysis with global macroeconomic views. And so the insights that Mike brings to bear are critical in understanding what are the different range of scenarios, what could happen, what are the downside risks, what are the positive surprises.
The risk world of Peter Bernstein and Frank Knight of 1921, Professor, is a study of what we don't know, the unknown unknowns that are out there that Neel has written about. What are the unknown unknowns right now and as we look to 2012?
Well, I think the downside stuff we know. And Pimco's as good as any group of people at analyzing it. I think the unknown unknowns are the upside surprises that Neel was talking about before. We could have a major technological breakthrough and
But this is a critical point. Michael Porter, and I'll see him in Davos hopefully this year, is adamant about U.S. technological progress. All the gloom and doom and all that isn't there. Is that enough, Professor, to lift us out of this malaise, to get us beyond the new normal? Can our innovation alone do it?
Well, it can make a major contribution. I guess I wouldn't go up to 100%. I think we'll be left with some distributional problems and employment challenges for the middle income group, Tom, but it would be a big help.
You look at the challenges forward that everybody has. We were joking earlier with Bill about 201Ks. Is the single point in the equity equation that we're just going to have to put a lot more money away for retirement?
I think that that's a big factor. Remember, people think about what's their most valuable asset being their house. People's most valuable asset, if you're lucky enough, is their job. And so the fact of the matter is people may need to work longer than they had expected to, and they need to save a little bit more, and that should be okay, right? It's not the end of the world if someone has to work 1 or 2 years. It's a lot better to have that than to not have a job. And so I think people's income is very, very important as well.
Neel, within the equity return and going from Michael Spence's world and other academics over to you, what's a single thing you try to learn for every day from academic economics, finance, and investment?
I think it's history. Many of these problems.
That's what I was hoping you would say. That's the right question. Thank you. And that was a point at UVA here on Friday. Speak again on history.
I was just saying that so much of what we're going through, although it seems like it's unprecedented, in fact, people in history have faced many of these challenges before, and we can learn from things that they tried and failed, mistakes that they made. Hopefully we can make fewer mistakes and make the path forward a little bit easier.
Professor Spence, I'm not a fan of beta. I look at these, the CFA talk, Jensen ratios. Thank you to William Sharp of a school north of here. But the idea of beta and analysis, are we going back to a more humble, fundamental research of the 50s and 60s, or can the math still work?
Well, the world, the economy around us is changing structurally. The financial system's changing structurally. I don't think we're going back anywhere. So we're sort of inventing, as we go along, a different pattern. I mean, Pimco's busy trying to figure out what the underlying risk factors are so that they can base their investment decisions in part on that. It's very important, but it's certainly not going back to the past.
Did you get lost surfing? Why are you here?
Every once in a while I come here to learn.
Did you come here to learn? What do they learn from you? What are the questions that an academic gets in a place worried about alpha?
Well, I think what we spend our time on is what Neel talked about before, is the sort of macroeconomic view. What are the risks and upsides in the emerging economies? How does the situation in Italy, where I live 2/3 of the year, look, etc.? So it's that component where I try to make a contribution, but as I say, I think I'm more on the receiving end than the delivery
I would
part.
agree with that. Neel, last word to you. We look at Brazil, we look at China, the expertise that the shop has in emerging markets. You've said to me before, and Mohammed said as well, it's one thing to look at equities, but they're discrete from the economic analysis. Where are the equities right now of the emerging markets?
Well, it depends on the country. So take Brazil. We think Brazil is very strong fundamentally, though we don't think Brazilian stocks are attractive because it's already priced in. We are finding attractive individual stocks in China, in Russia, in some other emerging economies, but we're not buying the country. We're buying individual companies and analyzing them in the context of their economic
What
environment.
about Japan? What an interesting economic model of 30 years. Is there opportunity in Japan?
Again, on the individual company level, yes, but one of the things we look for is we look for growth. Growing companies paying healthy dividends. Where's that growth going to come from? Even in the U.S., in a slow growth, new normal environment, some companies can have higher growth by selling to higher growth markets.
No, thank you so much. Neel Kashkari from Pimco, and just thrilled to have Michael Spence as well.